volatility actually tends to be very low. In fact, I think the last reading that I saw on the KLCI, I think as of just a couple of days ago, volatility was actually just less than 10. And volatility reading on a 30-day basis, when the volatility is less than 10, it actually tells you that the market is going to rally even more. And that's what we saw in the past few days itself. Okay, and as you can see, the arrow there, the two green arrows, one pointing down and one pointing up, is the index movement and how the volatility actually has come off. Now let's move on and talk about something from the US. I'm sure if you have seen some of the slides from Lorraine as well as Julian, you note that a lot of economic indicators that we measure are actually economic indicators that tell you what has happened, let's say last month or the month before, all right? Because generally a lot of economic indicators can only tell you what has happened, not what's going to happen. And that is why economists or even strategists like to look at leading indicators as a better tool to gauge direction of markets. So what I've done is that this is not a very widely followed index in the market. It is called the US Economic Research Institute Weekly Leading Index of the US economy. It actually tells you where is the US economy headed based on some of the indicators that comes up, whether from the financial market or from the real economy itself. And it tells you forward that where is the market or where is the economy headed, and from there basically tells you or gives investors an opportunity to gauge where markets are perhaps headed. As you can see from this slide, I actually drew this slide from January of 2000 to 30th September of 2009. And you can see that the chart basically showed very narrow movement right up to September 15 of 2008. Do you remember what's 15 September 2008? How many of you do? No. Collapse of Lehman Brothers. Okay? That was the day when Lehman Brothers collapsed and followed by problems at AIG. You saw some of the indicators coming from this index telling you that things are going to get worse. And worse it did. All right? The index fell to as low as almost minus 30. It's unseen. This index was constructed from 1970 and right up to today, all right, or right up to the period of September or October of 2008, it has never reached these levels. It was unprecedented. All right, it reached to a level of minus 28. Now you ask your question, where is this index today? It is at plus 25. This is at the highest level ever. The weekly, the US Economic Research Institute's weekly index showing in the past near 40 years. All right, so what does it tell you? It actually tells you that people are overly optimistic of where the US economy is actually heading, or perhaps where markets are. I mean, we all know the Dow hit 10,000 points yesterday, but it could probably be, well, very close to an end of this market rally. The other index that I like to highlight, this index is something that perhaps some of you are quite familiar. It is called the WIX index, which is basically the S&P 500. Measured from January of 2000 till end of September 2009, you can see that again is a measure of fear in the market. As you can see, at the peak of the crisis about a year ago, the WIX index hit as high of 80. Never before has this index gone even beyond 45 or 50 in the history of the index. And that's why during the crisis of 2008, sorry, I didn't change my slide. All right. Sorry. I didn't realize that I was not, looking here. I was looking at here. All right. This WIX index, as you can see from the slide now, all right, it hit a high of 80 in September or October of 2008, all right, at the time when markets were unstable. Lehman Brothers collapsed, and as well as some rescue exercise from AIG. Market was very uncertain. The fear factor came into the market and volatility increased. Okay, and today the index has actually fallen to a low about 25.6 or less than 30. In fact, if you look at the index levels, especially between 2003 right up to 2007, never has the VIX index even gone beyond 30, which basically tells you that market conditions are very stable. All right? And that's where we saw the US markets rallying strongly during that 4 to 5 year period. But today, the market is again back to some kind of stability. As you can see, the VIX index showing reading of less than 30 today. My next slide, again, is another index that I've taken from Bloomberg. This is called the Bloomberg's Financial Condition Index, which basically measures the financial market of the US, taking into consideration the equity market, the fixed income market, as well as the currency market. And what it tells you is that how investors are basically seeing whether the market conditions are improving or worsening. And you saw, again, similar pattern that we saw when the collapse of Lehman Brothers happened in September of 2008. The Bloomberg Financial Condition Index reached a level never seen before. It was minus 11 to minus 12 during that period of time. And today, it has rebounded so strong, it is back to almost neutral level. So what can we learn from here is basically to conclude my presentation, which, as I said, is very short and simple. What we can learn and the new opportunities that we have from here. I can say that basically as investors in the financial market, it is rather unthinkable to avoid volatility in the market, but investors are actually advised to embrace it as it is part and parcel of market. All right? If you look at it, we all embrace risk when we invest in the market, be it bond market, hedge funds, or even equity for that matter. So it is something that is inherent when we invest in the stock market. As market timing is crucial in making investment returns, watch out for these volatility measures to gauge the timing of the market. Extreme levels in normal circumstances suggest market peaks or actually market bottoms. In terms of opportunities, as we have observed, while the past 1 year has been a period of extreme circumstances which are not likely to repeat in character over the next few years, market volatility is indeed opportunity, but I must say it is not for the investors with low risk appetite. With that, I'd like to thank you.
Thank you for that, Pankaj. Actually, the issue of volatility, we have also thought very deeply about this. The way to think about it for many fund managers is it's a tool. Ideally, when you think it is worth taking the risk, you embrace volatility, you gear up your portfolio, and if you're right, you reap the returns. On the downside, you try and shed volatility. So volatility is no more than a tool. The problem with many of you and your investors, your clients, the way to articulate that to them is to think in terms of a roller coaster. If it's a big roller coaster, that's high volatility. They feel exuberance now, and then after that, they might feel tremendous fear. Whereas a smaller roller coaster would mean that they have less of these extreme emotions. What does it mean for a client? For high volatility, they can no longer take the pain and they exit at the bottom. That's and something you have to manage. With that, I like to actually start the panel discussion, and then later I'll open it to to all of you if we haven't answered any of, or I didn't pose any questions that you have foremost in your mind. Please feel free. Malaysia has a very strong equity culture. Less on the bond side, I guess, although bonds are fairly new. So I mean, we have a lot of data, differing opinions, including mine, perhaps. After all the economic data, where are the opportunities in equities? Would that be a fair question to ask? Where are the opportunities in equities?